For almost a year now, the markets have been in complete turmoil. Since that's happened, I've been able to make thousands selling covered calls in a particular growth stock. Want to learn how? Watch this video to find out. Let's go.
All right, folks, we're looking at the trade desk, a popular growth stock. This stock took off back in, let's look, once the pandemic hit, like a lot of these other growth stocks really took off, and it climbed to even higher price levels to about $115. But what I want to talk about is not the price of the stock, but actually selling a covered call in this growth stock. And I was able to do that. I owned a couple, maybe 20 or so shares. The stock split, did a 10-to-1 split, which enabled, this stock originally was very expensive. So the 10-to-1 split enabled me to, at that point I had 100 plus shares. So I was able to sell some covered calls in this stock. Okay, so this is the master spreadsheet of what I did for my trades, my covered calls. Granted, I don't have all the data here. I just mainly have the credits and debits. As you can see, the credits were positive. Anytime I bought back a option, I marked it with a negative. So I started off on August 10th selling a 60 cent $100 call that expired 10 days later. I bought it back at $20 for a 40-cent profit, okay? And you can see if we go down to the sum, you can see that was the profit. And before we go further, I just want to show you the chart of the trade desk. So here is August 10th, 2021. This is when we started the trade. We were trading right below $87. And you can see over the next couple weeks, we started to rally down, trend down. And that whole time, we were selling a covered call and we were collecting premium until we had earnings. Usually I like to close out before earnings. I did not. The stock rallied super hard and got up to $115. I'm going to show you in the spreadsheet how and what we did to basically stay profitable while the stock moved against us. So let's go back. All right, we're back in the spreadsheet. So we started, like I said, August 10th, and from there we collected premium for about a good month and a half until things started to go against us. So let's just see how much premium we collected. Boom, 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 boom. So we collected $450 worth of premium. We started at $87.50, the stock price, that is. And you can see down here, the stock price was starting to get lower. Then earnings happened, okay? Stock price went up to $97. We were short a 85 call. We had to close out of that call and realize a loss, okay? And then we rolled out in time, 2 months out in time, and we rolled our call strike price up as well. So we rolled out and up, and we collected basically a larger credit, because obviously 10.1 is larger than 9.4. This then moved against us again, and we had to close for a bigger loss, so 14.3 debit, okay? And we went ahead and rolled out 6 months in time. We rolled 6 months out in time, and we rolled to the 105 strike, okay? We received a credit of $15. Overall, we increased our credit by 70 cents, okay? And then not too long, about 2 months later, January comes, and the stock begins to fall again, okay? So at this point, I closed out for $5.03. I bought that back and opened up another call at $95. So I kept the same expiration but rolled down to collect a larger credit, okay? And then basically, as the stock price falls more and more, we're at $80 here, now we're at $71. Yeah, the stock moved down to $71 a share. And as the stock price was moving down, I was able to actually roll down the strike, and also, instead of rolling out in time. I was rolling forward, back in, I guess you'd call it forward in time. So I regained some time on the expiration by about 30 days, and I then bought that back for debit, and then I was able to roll time forward or back, however you want to say it, by almost 3 months here into the February expiration cycle. And in order to receive a larger credit, I had to also roll my strikes down 17 strikes from 90 to 73. You can see I received a credit of $3.85, so 40 cents larger than what I sold it for. And I just want to go right back to the chart just to give us a good idea of what's happening with the actual stock price. So earnings happen, we get up to $115 per share practically, and that's in November. But then we get to, now December occurs, and this is right around the time when I think the Fed came out with a policy saying that they're going to start raising rates, and this is when things really started to get bad quick. So we were at 115 in November, mid-November, and then just a few days, a couple weeks later, we're under 100. And then by the time mid-January hits, late January, we're at $60 a share. Okay, and then we did rally a little bit after that. Okay, so we got through that patch where we saw a large increase in price and then it dipped back down. So then from there, so on and so forth, we have a series of debits and credits. We have a similar type thing where the price, stock price went up a bit, came back down. And now, fast forward to now, basically we rolled out in time and took some credits. And overall, this is our sum for about a little over a year of just selling covered calls and receiving a larger credit each time. Granted, had this, had we just sold the stock at $100, that would have been just selling 100 shares at $100 would have been a more profitable strategy than collecting $2,000 worth of credit when the stock has fallen to about $50. But we still own the shares, and so that you have the benefit of still owning the shares. So yeah, that's it. That's $2,000 of credit received in a year of just selling covered calls. And yeah, that's it. Basically, the idea is if you get in trouble, just push out in time and try and roll up for a larger credit. And if you hang in there, granted, this is a special case because we've been in a pretty bad bear market. So yeah.